Boa tarde a todas e a todos. It's a real pleasure to be speaking with you this afternoon. I know it's the last session before lunch, but as Martin had said earlier in the day, I promise that this will be making finance fun and exciting. Again, my name is Alex Honjiyo. I'm Deputy Director of the Health Finance Coalition. We're a sister organization of Forecasting Healthy Futures, and really happy to be here today to start this dialogue with you all. As we've heard throughout this week's summit, the challenges facing our health systems are intensifying, driven by climate shocks, shrinking public budgets, and slash development aid. But the urgency to build resilient, equitable, climate-smart health systems has never been greater. And to meet that challenge, we need more than just political will. We need capital, and lots of it. And we need to move beyond thinking just about the traditional or conventional sources of funding and really start reaching out to the private sector in a meaningful way. And so here in this session, we'll explore how health financing can expand beyond conventional development models by incorporating innovative and blended finance mechanisms that unlock private capital and foster cross-sectoral partnerships. So this is about expanding the toolbox of what's possible. And we'll do that by highlighting concrete examples from my colleagues, our panelists that I'm about to introduce, that can talk to you about not only what has been used, but what can be used to unlock significant new investment for the health sector and make this capital go even further. So we're joined this morning by an incredible panel of experts who are not just thinking about these solutions, but are actually building and implementing them for real transformative healthcare impact within the context of our changing climate. So without further ado, welcome Noorin Mawani, who co-leads the Transform Health Fund, a blended finance vehicle targeting early-stage investment in health enterprises across Africa, managed by AfricInvest, Africa's leading private credit, equity, and impact investment firm. She brings a wealth of experience in structuring funds that deliver both financial returns as well as real health impact. And Noorin is based between Toronto and Nairobi. Next is Kusi Hornberger, a global health expert in innovative finance and system transformation, and is a partner at Dalberg. There, he leads work on blended finance mechanisms, investment design, and public-private collaboration to achieve health and development goals, including a community of health practice that we'll hear about later on called Investors for Health. Kusi is based in Washington, D.C., which is my hometown as well. And we have, finally, but not least, Gustavo Ballestreri, who leads health sector investment at Vox Capital, Brazil's first impact investment fund. He specializes in financing scalable businesses that deliver measurable social outcomes with a focus on improving health equity and climate resilience through sustainable financing structures. His work bridges capital markets and community health across Latin America. Gustavo is based in São Paulo. Welcome, all panelists. And so let's dive in. So my first question today is for you, Kusi. Thanks so much for joining us. Oftentimes in the impact investment space, we sometimes throw around these terms of innovative finance or blended finance a little loosely, but they are terms that have distinct definitions. So in your role and from your perspective, what do you see as the difference between blended finance and innovative finance?
Boa tarde. Thanks, Alex. Excited to be with all of you this afternoon. I used to live in Brazil, so it's a place near and dear to my heart, and I'm sad I can't be with you in person. That question that you ask, I think, is a great starting point. The terms blended finance and innovative finance get thrown around a lot together, but they're actually not exactly the same thing. So I think it's important to distinguish what the differences are. I often like to think of blended finance and innovative finance as teammates on the same team. They have the same goal, but they have different capabilities and maybe talents that they bring to the team. So blended finance, one could think of as teammates where one player is providing the assist to the other player to score. Essentially, it's where a philanthropic or funder or often donor organization provides concessional financing in order to allow for a commercial investor to participate in a transaction or deal or fund. So it's that mix of capital, or the blending of different types of return expectations that enable the transaction to take place. Whereas innovative finance, I like to think about as teammates actually maybe inventing or playing a new sport together. So like going from traditional like tennis or a paddle sport to inventing something like pickleball, where you're challenging the assumptions around the traditional strategies and structures that are in place in financing, whether it's grants, debt, or equity, and using them in a different way. So there's a lot of different innovative structures out there. And specifically, when we talk about innovative finance, we're talking about using innovative structures to center on outcomes or impacts. So in the case of healthcare, it's about centering those structures to be more outcomes oriented and being able to measure and understand how we're achieving results. So blended finance is actually, one could say, is a type of innovative finance, although I think at this point it's not so innovative anymore because it's been used so frequently. But that's how those two terms relate. They're not one and the same.
Kusi,
but they both play a critical role. So yeah, back to you.
Kusi, thanks so much. I really like the analogy of teammates. I was at Maracana last night to watch Flamengo, which is my team, and they could have used some of this dynamic. Noorin, speaking of maybe one half of this team, I'd love to ask you a little bit more about Transform Health Fund, the fund that you co-lead. It's a really great example, I think, of blended finance at a fund level. But I'd love to hear you really break down the structure of how this works and how you see this unique structure help attract more investment to expand affordable healthcare for communities that are at the margins and most vulnerable, particularly to climate change.
Sure, I'm happy to, and hi everyone. Apologies that I can't be there in person. It has sounded, and we were listening to a bit of the last sessions over the last couple of days, and it has sounded like quite an informative set of conversations. So Alex, to your point around how does it work in the Transform Health Fund, because it is a blended structure. I'll give you a sort of a brief of how it works, but then a lot of the things that we learned, because we definitely didn't get it. Blended structures are always quite bespoke. And so you can do a bunch of things right, but you can also do a bunch of things wrong. And it's useful, I think, as the field grows to talk about what are some of the challenges that we face so that the next blended structure is even better, hopefully, than the one that we raised. And so in the Transform Health Fund, it is, like you said, it is an Africa-focused healthcare fund. So that's primarily what we focus on. And really, as we saw the challenges in healthcare, we have seen over the last, I'd say 10 to 15 years, a bit of a pivoting away from people wanting to invest in healthcare in Africa. Meanwhile, we've seen the needs grow dramatically. And particularly with the current environment over the last couple of months, that need is growing even more. And so one of our goals in raising the fund was not only to invest in the populations who need it the most, who need healthcare, accessible and affordable healthcare the most, but also to bring in some investors that wouldn't have otherwise necessarily invested in Africa in healthcare, because we need more dollars. We have to expand the pie. It can't just be the donors and the DFIs who are supporting this particular subsector in Africa. So that was one of our main goals. But when we spoke to a number of those investors, their return requirements were a bit higher than what the fund could provide. And their perception of the risk was also higher. And so we had to find a way to have a set of catalytic investors, what we call like sort of the subordinated investors in the fund, support the more commercial investors who needed a bit of basically risk off-taking and a bit of enhanced return. And so that's how we devised the structure of the fund. Normally, a fund would only have one share class, only one kind of investor. And here we really differentiated it into two so that there was one, your philanthropic donors, your, in some cases, parts of the DFIs who could support and who have been in Africa longer could support some of the newer investors coming in, some of the corporate investors, by taking some of their risk. And so that's effectively how it works, and how that's actually operationalized in the fund is through what we call the waterfall, which is basically just how we return capital back to the investors. And so we prioritize returning capital back to the commercial investors before we return it to the catalytic investors. So the catalytic investors take that risk for them. Some of the things we learned, like I said, blended structures always very bespoke, which means also very time consuming to fundraise for. And that's just something people need to be aware of. And there's no one right way, but you're really stitching together a bunch of different investor interests into one. The other thing we learned was we stayed pretty steadfast on how much of each type of investor we needed, how much of the commercial and how much of the catalytic. And really, that is one of the most important pieces, because if you get that right, you can actually truly enable your investment strategy. If you don't get that right, you actually can't deliver the investment strategy that you promised to investors. And so for us, it was really, really critical to get that balance right so that we could actually enable our investment strategy, which was really targeted the low and middle income patient populations. And so for us, the advice I would really give to anybody who's raising a blended structure is start with who's the patient population, or who's the population you really want to target, and work backwards from there around what your structure should be, not the other way around.
Noorin, thanks so much for that overview. I think that's a really helpful perspective, particularly to give some of the challenges that are really behind these blended structures, but also that there is opportunity within this space. Gustavo, boa tarde, obrigado de novo por falar com a gente hoje. Vox Capital has been a real leader in Brazil and beyond, designing innovative investment approaches to tackle both climate change and human health. So what strategies have you used at Vox to attract more capital to this intersection of these two critical sectors?
Well, firstly, good afternoon. I wish I could be there in person as well. It seems like a great event to exchange ideas. And thanks for pointing that out. We indeed have several initiatives addressing actually both human health and climate change, tackling the social and environmental aspects. So for that, we're using different instruments. So firstly, in the human health area, we have a venture capital fund in partnership with Albert Einstein Hospital. So that basically works as a corporate venture capital fund. And with that, we utilize some alternative instruments of convertible debt that basically leverages high-risk companies that utilize technology. And with that, we are able to disrupt several verticals in this field. And that's basically the fund I manage here at Vox Capital, a health fund in partnership with Vox Capital and Albert Einstein. And for the climate change problem, we tackle that problem differently. So we actually have a new area that is called nature-based solution area, and it's dedicated for creating basically new types of financial instruments in line with everything that we have been discussing here today. And we are actually raising a new interesting fund called CCCAT, which is translates to Catalytic Capital for Agricultural Transition, and is a blended finance instrument. And basically, this is just to fill the equation to find the funding gap that basically provides concessionary capital for enabling market returns for the senior tranche and in a given set of financial instruments. So basically look for several opportunities in the market, and wherever they need a mezzanine tranche or a junior tranche, we provide the capital. And that's basically a financial engineering that we do. It's a strategy that we split a fund in several tranches. And there's the senior tranche where you basically want to offer the market returns to basically with less risk to offer the market players for the that instrument. And there's the mezzanine and junior tranches. So there's the tranche to basically have the first loss and you want to elongate the maturity of the instrument. And not that many players in the market want that. And that's the gap that we find that is important to be more active. And that's why we developed in the CC Cat Fund to basically provide more capital to this type of mezzanine and junior tranche to enable several of these instruments. And with this composition, we think that we make the whole financial instrument more attractive to, let's say, market investors. So basically, with less capital, we are able to get more inflow of capital from the whole market to those instruments. And basically, in this CCAT instrument that we're developing right now, the idea is to tackle problems in Amazon and Cerrado here in Brazil. So what we want are mainly three pillars. We want to plantate soy and agriculture over pasteurized land, so a land where you don't have anything, basically. You want to bring some sort of a plantation there. And we want to intensify the cattle production, so we don't need to devastate new area to produce cattle. And we want to inflow of more financing for the agroforestry as well.
Gustavo, really, really interesting examples. In particular for me, the nature-based financial solution is super compelling, and I've never heard of that before. It's so unique. Congratulations on the work that you're doing at Vox Capital. So from this morning, we've heard from perspectives from Latin America and the Caribbean, from Asia Pacific, from the African continent, about really innovative and exciting examples of financing for health within the context of climate change in this panel and the panel before. Kusi, maybe back to you. You've been leading Investors for Health at Dalberg, bringing together folks actively investing in private healthcare across emerging markets in these major three regions I just mentioned. Both Gustavo and Noorin kind of mentioned some challenges in working with these innovative and blended financing structures just now. With the insights from your community of practice, why do you think we're not seeing more blended or innovative finance models being used for the global health space?
Great question, and one I often ask myself: why aren't there more players like Vox and Transform Health Fund? And I think the answer is, telling, because in our community of practice, which is the Investors Health community, it's 26 investors who are actively investing sustainable commercial capital in emerging markets focused on inclusive healthcare systems. We're seeing relatively limited use of blended and innovative finance structures. And I think there's a couple reasons why. One is healthcare projects to date typically lack the investment-ready appeal that private investors seek. And that may be due to lack of familiarity or due to the actual financial returns that they're offering, or just the fact that there's insufficient sort of shovel-ready or investable projects, period. And so the lack of clear revenue streams, the lack of clear sort of established business leaders to invest in, et cetera, limits their interest, period, across the board. It's a rather small community of practice. 26 is really small compared to the global ecosystem of funders. And even within that, when they go to invest, they prefer to use traditional approaches. Primarily it's debt and equity, private equity and private debt. Now, there are more players, and I'd love to hear more from Noorin, like Transform Health Fund, which are trying to leverage things like technical assistance and two tranches in their capital structure, which make them blended structures. But it's still, unfortunately, I think the lack of precedence, the lack of sort of familiarity is making a big challenge. I think there's also a knowledge, on that point, there's a knowledge gap. So many stakeholders are just unfamiliar with how to structure or implement blended finance deals once they have the idea, right? And again, go back to you, Noorin. There's probably some war stories from just the whole experience of bringing that fund to market. There's relatively thin number of intermediaries that can help players actually structure in the right way and do it at a cost that's still makes the whole fund viable. And things often take much longer than expected. And so that sort of is intimidating, and there's the lack of know-how how to do it. And so this results in missed opportunities to leverage different pools of capital to work together in blended structures. And lastly, aligning diverse stakeholder interests. Governments as payers, insurance companies, donors, investors, providers of healthcare, et cetera, can be complicated. Right? Let's just be honest. There's different parties at the table, and they have different objectives, risk appetites, and timelines. And getting them all in sync to align around a single structure or a single goal can be complicated. And so I think that undermines why we're not seeing more blended finance structures, particularly in healthcare. The same can be said also in climate adaptation, by the way, and the intersection of climate and health. And so I think it's those three things: sort of the lack of investment-ready projects, the knowledge gaps, and the difficulty aligning diverse stakeholder interests are the primary things that we hear from our community. But I think that's not to have despair. I do think there's a ton of opportunity here, sort of missed opportunity almost, to bring different stakeholders together and to do much more in blended finance structuring, even in this current paradigm, to bring more private capital to the table to invest in healthcare and invest at the intersection of climate and health.
Kusi, I feel like you set up my next question for Noorin and for Gustavo so elegantly. So I'll turn this to maybe ladies first, to you, Noorin. In your experience, then, okay, how do we then address those three challenges that Kusi so helpfully brought up, and in particular for the African context, if you can speak to maybe strategies that meet the challenges for markets in sub-Saharan Africa?
Yeah, it's a great question, and Kusi, I think you put it so elegantly, of the challenges that are faced by investors in the market, and particularly impact investors. I think this piece around the shovel-ready nature of deals is a really important one, particularly in Africa, and then particularly within the healthcare space. There is not a lot of deals that are just ready for you to invest in. And so one of the key pieces of our fund is that we actually partnered with the Health Finance Coalition, so that we had extra capacity and extra resources and extra expertise to basically go and help develop some of those deals for us. Because as a fund, it's really tough to spend a year or a year and a half trying to develop a deal, right? The economics are not made to do that. And so really being able to partner with other players in the ecosystem that can support companies in getting ready to raise financing. Often these are SMEs. Often they haven't had traditional financing before. They don't know what it is required to raise debt or to raise equity. And somebody needs to work with them. That's a journey that a lot of SMEs need to walk. And so I think one of the biggest things that will make our fund hopefully successful is being able to partner with other folks like the Health Finance Coalition. I would say the same thing as we look to your second point, Kusi, when you talk about how, it's really, it's useful to use other tools like technical assistance and also guarantees from other funders in the ecosystem. So often we'll look at a deal, we'll say, look, this has a lot of risk. This company, let's say, is the primary payer is the government. You have 98% of your revenues that are based on the government. That's a risky context to be in as an investor. And so we will often go to other players in the ecosystem who can provide guarantees to offset some of the risk from us. We will take a lot of it, but we also want to share that. And so I really think in markets like Africa and on the continent where you may not have as ready of a transaction and you may not have the same depth in the markets, you really do need to work with the ecosystem of players. That's really how you get transactions done. The other thing I would say that's pretty unique, and you touched on this a bit, Kusi, is the dynamics of healthcare on the continent itself. If we look at we look at how healthcare is delivered, there is no large insurance provider. Governments provide insurance in very few countries across Africa. And so really it's left to the individual. And that means affordability is a huge concern. It is really, really tough. And so it is one of the strategies, to your point, Alex, to get deals done is really to also partner at the transaction level with donors and try to actually blend at the transaction level, because we have to face the reality that the affordability is just not there. And if patients don't have the affordability to pay for healthcare, businesses aren't making 20, 30, 40% margins, right? That's not the kind of businesses that we see. And so you really do have to find other blended sources of concessional finance at the actual deal level and the transaction level itself. So we've done that at the fund, but we also try to do it at the deal level to make transactions work. That is just a facet until we see insurance penetration go up, until we see other safety nets that are built in by the government. This will be a facet of the way healthcare is delivered in these markets.
Thanks so much, Noorin, for that. Gustavo, over to you from the Brazilian, and perhaps if you can draw on your even broader regional Latin American experience. Same question over to you.
Yes, I like to point out several different instruments that we have here in Brazil, even Latin America, some other types of instruments enabling this more innovative financing to enable this sort of projects. I can give you some examples here in the space for healthcare, for instance, where there's something I like to call synthetic blended finance, which is not exactly a blended finance, but it shows some similar logic by the government, basically de-risking some sort of initiatives and companies by being the first investors to basically deploy some sort of capital for the scientific development, for some sort of startup or even project. And just to mention a few players that are doing that right now, I can say FAPESP, which is from the state of São Paulo, but for sure Rio also has some of these initiatives too, as other states in Brazil. There's FINAP, which is a national entity also allocating a lot of capital for that end. And there's BNDES, which is the developing bank from Brazil with lower interest rates lending and all sorts of grants that they also provide for all these companies. And usually these sort of earlier stage companies and projects, what they lacked is this first impulse for starting the project. And basically the private sector doesn't want to enter in this first stage of development. And that's why this first grants and initiatives from the government is so important in the region. So they basically de-risk all these investments. And later when they grow, of course, they can attract more private capital. And the interesting part of this mechanism is that by, for instance, investing $1 or real in any sort of company, you can say the company actually has two. So basically you multiply the potence for giving cash to these companies and initiatives. And that's actually the reason the whole ecosystem in the healthcare space usually works in the country. It's probably sustaining the whole industry by being this first deploy of capital. And I'd like to point out other initiative that is really interesting, which is in parallel of everything that happens with these public entities, which is some private-public partnerships. And I can mention one from Einstein that is really interesting. Some flagship hospitals in the country has some sort of beneficiary institution and tax-free incentives. So what they basically do is allocate all the taxes you would pay back to the government to other projects, to the health sector in reference. So basically, ProAge is the name of these initiatives, and it allows philanthropic centers such as hospitals and especially Einstein. And there's several ones. It doesn't count to 10, but there are several hospitals in the country that categorizes within this specific tax regime. And they developed several projects that benefits the Brazil public health system, which is the SUS. And it's a very important catalytic capital because we know that not enough capital is allocated to SUS, and there's quite many people that needs access. And by doing that sort of partnership, you can actually allocate the incentives to the public sector again. So that's really interesting to point out.
Gustavo, Noorin, I think that both of you touched on a really important point, that there is still a very important role for traditional sources of capital, right? For grants, for funding from governments within this space. But it's all about mixing and acting and working together so that we can catalyze and really pave the way for even larger amounts of money, creating markets, creating opportunity, and ultimately creating access and impact and healthcare outcomes that is really why we do what we do in the first place, right? And that's the whole reason. Maybe one last question for that I have, at least for the three of you, and then we'll see if we have any questions from the audience. And folks, if you do have any burning questions, please do go log into the app and ask away. Our panelists are here to answer really any and all questions. So for the three of you, what are some of your observations about how investors are responding to the current policy uncertainty in the market regarding climate investment activity, or rather how climate is impacting other sectors like health? And Kusi, maybe I'll start with you.
Okay. And I would love to hear from firsthand experience from AfricInvest and Vox Capital, right? It's interesting to hear from them. But it's actually good timing for that question, Alex, because we just did a survey of 34 climate-focused impact investors across the globe to sort of how they're responding to the moment. And there were some interesting insights. The first, I think, important insight is that, and these were mostly private, there was 33 of the 34 were private investors, and it's a mixed strategy, private equity, private debt, and venture capital. These investors are not pulling back. They're just stepping up, or they're adjusting their approach. So 47% of that sample said they were planning to increase their investments in climate or climate-related activities in the coming year, or coming 2 years. The rest said they plan to stay the same, not decrease. However, those same respondents, when we asked them how they saw the broader ecosystem or their peers, what was going to happen, they said they expected, 47% said they expected their peers to decrease their investment, right? So there's something about confidence in self, but also there's clear signal that, at least for these players, and that they represented 1.5 trillion AUM for climate, by the way, so it's not a small sort of capital pool, are remaining committed despite the uncertainty in the shifting policy environment from the public sector, right? Private investors seem to be remaining committed. And they're particularly interested in investing in proven solutions. And what I'm seeing is shifting strategies, or at least what they're saying in the survey is that they're shifting strategies and not their commitment. And part of that is geographic, so it's shifting more towards Asia, so plans for increase in South and Southeast Asia and East Asia and the Pacific, mixed in Latin America and the Caribbean, mixed in Sub-Saharan Africa, and then in North America, plans more of a signal of decrease. But more interesting than geography was what type of climate solutions they plan to invest in. And here the resounding sort of response was they plan to increase in existing technologies that are working. Right, so scaling existing technologies and maybe decreasing investments in climate tech or things that are unproven or less scalable at this point, right, where the return profile isn't as clear. And so that I think is an interesting insight. And the last insight from the survey was...
Can I interrupt you for a moment?
Yeah, go for it.
That's a really interesting insight around doubling down on existing technologies versus new, something I wouldn't have expected. What do you think is driving that?
I don't know. I mean, that's just the data. My suspicion is that the return profile is stronger, perhaps. in the existing solutions, and there's like more commercial opportunities there than there are in the new tech. There's less subsidy available perhaps in the ecosystem from blended finance for the new tech that would be required to allow those to succeed. But that's my interpretation. I don't know. But thanks for that. The last thing that we saw, which is really salient for this discussion, is that blended finance is becoming the go-to strategy to mobilize capital in the ecosystem, particularly in tough markets, whether it's healthcare or climate adaptation resiliency. That investors are seeing tools both in the past, like guarantees that Noorin mentioned, and first loss capital, as critical to be able to invest in underserved markets or underserved segments. And not only did they see those tools being effective in the past, but they see their potential moving forward. And so I think it was 57% said they expected to see an increase in the use of guarantees in the coming 2 years. And so that is very reassuring to somebody like me that our sector is not dead. There is private investors who are stepping up, and the need and use for blended finance is more than ever. I'll stop there.
Thanks so much for that, Kusi. Oh, since you were so eager to intervene, Noorin, I'll turn it to you. How are you seeing this work in your sector?
Yeah. No, it's a good question. So I think actually in the buckets that you defined, Kusi, we as AfricInvest, as a private provider of capital, really fall into the bucket of doubling down. So we, before the changes over the last couple of months in the environment, we had already started to raise a climate fund, and our climate fund that we're raising is also a blended finance structure for many of the reasons we've discussed. And we have actually found that while the funding environment around us has changed a little bit, obviously, over the last couple of months, what we see in the market as opportunity hasn't been affected at all. And so those companies are still there that still require funding to get their technologies off the ground, whether it be in more climate resilient agriculture, whether it be in, more eco-friendly mobility. There's those opportunities and really do still exist, and the need for adaptation on our continent is still greater than ever. The fact that funding and policy has changed means nothing for the reality on the ground, to be honest. And so we have decided as a firm that it's still a strategy that we really want to pursue. Doesn't mean that fundraising will look different, maybe more difficult, and we will target different investors as a result of the changes over the past couple of months. Definitely. That is for sure. But our resolve to sort of still be able to support the entrepreneurs and the companies that still need it in country is still the same. We just have to go about it in a slightly different way now. For example, in the climate fund that we're raising has a lot of similarities to the healthcare fund that I run, and there'll be a different set of investors. For example, we had USAID as an investor in our healthcare fund. That, those are the types of changes we're going to be seeing, is that, there's going to be a different pool of investors. It just means we have to go find them.
Thanks so much, Noorin. Gustavo, I'll turn to you now, and we actually have a question for you that I think actually dovetails quite nicely with the one I had asked for the group. Gustavo, the question for you is, we just heard from the previous panel that nature is infrastructure and infrastructure is nature. And so for you, Gustavo, how are you selecting among nature-based solutions that really do create resilience in health systems while they functionally protect nature and biodiversity? So over to you.
Yeah, sure. The fact is that all of these instruments already exist. The market already exists. The problem is that we don't have the concessionary capital to basically make it viable and maybe bring to the market all these instruments that are already being designed, being deployed. So the way we are looking to the pipeline for this fund of the CCAT, for instance, is by understanding the whole supply chain of the agro industry and map wherever capital is needed and wherever there are financial instruments that we might be able to help. And actually, we have already mapped more than 30 potential opportunities in partnership with big companies from the agribusiness. And for the pipeline and fundraising process, that's the way we're going to straight to this main supply chain from the industry and selecting the best instruments. And of course, as soon as finish the fundraising process, we're going to start the better diligence in all of these in these instruments to understand which are the most well structured, the most well designed, and if needed, we can also enter together with the management team to maybe try to improve some sort of the trenching and securitization of the instruments.
Super, super interesting and great to hear that you're seeing such a robust pipeline of investment opportunities, even within this challenging policy environment at times. Thank you so much for your questions. As they're coming through, I'm trying to read them. This next question is for you, Noorin. These types of structures, I think they're referring to blended finance structures. Sounds like they take our years-long projects to bring together. How can we make it easier to pull these together and do it faster?
That's a great question. How do we make it faster? I think, honestly, I think there's two things that I think would make it significantly faster. One is having investors really identify what their own risk reward appetite is. What we often find is an investor will put themselves in one of the share classes, whether it's senior or the junior one, and another investor will come in and say, well, they're my peer, so I'm going to go in their share class. And really what ends up happening is you have a crowd in one share class or another. And I think it's really, really important for investors to really take a look at what is the impact they want to create. And then even though there will be a share class that offers more return, for example, really play in the one that fits them the best for their unique kind of capital. Sometimes we have seen, I'm not talking about our fund specifically, but sometimes we've seen like a donor, for example, say, oh, we want to be in the senior share class. And it's sort of like, well, you have really unique capital. There's not a lot of catalytic investors out there. So if you have that kind of unique capital, go in the share class that makes sense for you, not the one that is always the highest returning. So really having a level of sort of frank discussion of and awareness of sort of what is as an investor, as an LP, what is your risk return appetite, even there if there's a better share class on offer. I think that's the first thing. I think the second thing is there are some catalytic investors where the market is actually relatively opaque. So I'm not talking about your large donors, but sometimes the family offices, for example. That market, for many good reasons, is a little less defined. And so often when you're going to raise a fund, there's pockets of capital. Like everyone knows the DFIs, the multilaterals, the donors, there are all these big names, you can get to those. But the smaller, the family offices or the foundations, they may actually be less known, but your investment strategy might fit really well for them. And so some sort of transparency in that market could be quite helpful as more blended structures are being raised.
Fantastic, Noorin. Thank you so much for that. Bringing investors on a journey. Unfortunately, I don't think we have time for any more questions, but we will make sure to get the questions that we have to the panelists that you've directed them to afterward. Thank you all for this very robust and insightful conversation. I think we can say that we've heard today that financing for health in the face of climate change isn't just a challenge, it's an opportunity. It's an opportunity to think creatively, to bring in new folks and design models for investing and financing that are not only innovative and shiny and new, but can really work to scale and create impact in a meaningful way. So please give a round of applause for our lovely panelists, Noorin, Gustavo, and Kusi. Thank you for your leadership, candor, and your time today. Thank you very much. And I believe it is now time for lunch.